My current yield, if I were to hold this all year, would be about 4.2%. Fairly well diversified to help subsidize things like bills, mortgages, and such. So I wanted to make this quick video just to show you guys an alternative way to generate passive income off of your tax-free savings account. So this current setup, I use Wealthsimple, and I really prefer Wealthsimple over really any bank in Canada. They make everything very simple, hence the name. So I'm using this video as a way to track the actual progress of the portfolio, as well as test if this is a viable solution long term. So simply take all this information, not as investment advice, do your own research. However, it will be interesting to follow along the portfolio's journey, because the ideal goal for this portfolio is to generate passive income to help subsidize things like bills, mortgages, and such. If you have disposable income and you're investing in a tax-free savings account, then this might be an option that you may pursue once you've done your own research. So a little backstory, just so you know, this is about $70,000 was the initial investment into this tax-free savings account. And currently I have 30% stocks and I have 70% in a cash management ETF that is currently paying a 2.57% yield. So if you don't know, on a tax-free savings account, any money that I pull out of this account will be tax-free. So if I had put 70,000 in, 10,000 in, doesn't matter. It's when I take that cash out, I will not get taxed on any of the earnings inside of that investment vehicle. So currently I have 70% invested in the cash management fund, which is an ETF, an electronic traded fund. What this is a portfolio of bonds, corporate bonds, and just T-bills, things like that. It's in a fund that's controlled by a fund manager, and your portfolio value when you purchase this management fund does not decrease or increase in value other than like 10 cents. It ranges about 10-15 cents. So you don't lose your purchasing power when you purchase this management fund, and then they end up paying you about a 2.5% current yield on your cash held in there. So I use it as a cash buffer to slowly rotate out of cash management into stocks. And the whole goal with this thing is to spend 12 months taking 70 grand and slowly investing into a portfolio, because I think the market is really frothy right now and could be very well heading into a crash of some sorts. The whole goal of this portfolio is not maximum appreciation. So I want you to understand that this is not about maximum appreciation. It's simply about yielding with a chance of appreciating better than, typical blue collar stocks. So I am heavy in tech. So I have a lot of exposure to tech through these covered call ETFs that I will discuss. And with these covered call ETFs, the premium, the dividend yield on it is quite high, but I also have exposure to a high growth area that, let's say, Atco Gas will not have. The performance of Atco Gas is actually funny right now because of the Iran situation. We've had a run up on oil and gas stocks. Along with AI, anything AI related has been going through the roof. So I like to build my portfolio in a way that I have access or exposure, for lack of a better term, to the entire market. So I have defensive stocks, I have oil and gas, I have tech, I have gold, I have bonds. I diversify across the entire market so that if, one area of the market is dumping really hard, but oil and gas is spiking, well, I might be able to balance my value of the portfolio and hold its value long term. The ideal target I'm looking for is anywhere from like 8 to 10%, maybe 6 to 10% in appreciation in the actual portfolio's value, while also extracting income monthly from it. So if that is at any of interest to you, I can explain in depth for sure. But let me just show you kind of what has happened the past month. So this is a screenshot of my portfolio, taking out all of my personal information and just showing you what the market has done the past week. Now, the overall market returns over the past month have been negative 0.05%, so relatively flat. And I have generated a $245 monthly payment out of this portfolio in cash that I can extract from my tax-free and use it for maybe a phone bill, whatever. Currently, because I am 70% bonds or cash management and 30% stocks, my yield is a little bit lower than it will be when I am fully invested into covered call strategy. So my current yield, if I were to hold this all year, would be about 4.2%, which is still a really good number to be at. If you were in, let's say, retirement mode and you had $1 million, 4.2 might be enough to pay your bills and keep you going, while having some appreciation and not having that all cash management where you're going to have that inflation eat away at your yield or your purchasing power per se. So this is a lot of rambling, but I hope you understand everything I'm saying. If you don't, I can definitely explain further in another video. But let me just show you the portfolio quickly here so you can see overall my performance has been flat. I've lost $50 in value, which is relatively flat. And as you can see, I'll just quickly go over the holdings. I have ATCO Gas, I have Apple exposure, I have pretty much every space and AI ETF here. I have the Couche-Tard grocery store chain. I also have Bird Construction, which is one of Canada's biggest construction companies, Brookfield Resources, Berkshire Hathaway, Bitcoin exposure. I have Canadian Natural Resources. Next here, we have Enbridge Gas here. This is a utilities or equities ETF that has covered call. This one here, again, I've already mentioned. Microsoft, I have Johnson & Johnson, which is a massive company that holds like, oh man, they have exposure to like Band-Aid and all those household names. I have United Healthcare, I have Verizon Wireless, I have Nvidia exposure, Hydro One, Amazon, Google, I have Costco exposure. What have I not mentioned? Walmart, S&P 500 exposure. I have Power Corporation of Canada, which owns the majority stake in Wealthsimple, so let's call it owning Wealthsimple. I have RBC, TD Bank, Rogers. I have Broadcom, which is a massive technology stock. They have a lot of exposure to AI as well. I have a NASDAQ. I have AMD, IGM, Manulife. I have the Mag 7, they call them, the Big 7 covered call strategy portfolio in there as well. I also have HDIV, which is non-yielding, but it's like, or it is yielding, sorry. It's a covered call NASDAQ. I have Vanguard, all equity, so global equity fund, which does not really yield. It's about 1%. I have Dollarama, JP Morgan, US cash management, so I get a little bit exposure to US money, as well as I get a 3.6, I believe, percent yield on that cash management fund. I have a gold producing covered call, Fortis. I also have a gold ETF that just doesn't yield anything, but it gives me exposure to gold. TELUS, and that is the majority. Tesla, I've already mentioned, I believe. So that's the current makeup of the portfolio. So I have a lot of tech. I have gold exposure. I have utilities. I have staple household names, grocery chains. I don't think I missed much there, but yeah, it's fairly well diversified. I'm pretty happy with this current month's situation. It could be better for sure, but my whole goal with this is to generate a yield while holding my portfolio value above inflation. So that over the long term is what I would like. I would like my portfolio to grow at 6 to 10% a year, while also yielding me substantial income to help with my everyday life. So yeah, that is the current situation. Hope you guys liked the update, and I would try to do this once a month. That way you can just see how this covered call strategy actually works, and if it is a beneficial thing to do instead of the staple, just buy the S&P 500, hold it forever, and then eventually sell what you need to pay for your lifestyle. My whole goal with this is to have a portfolio that pays for my lifestyle while also appreciating. So that is the major goal here. In another video, if you'd like me to explain, I have a theory or an idea, use my covered call strategy to help pay for a portfolio line of credit. If you needed it in an emergency, you could borrow, especially with Wealthsimple, you can borrow against your stock portfolio if you needed it for an emergency, like let's say buying some new appliances, and then have the actual portfolio pay for the loan that you took against your portfolio as collateral. So that is a really interesting perk that you could be definitely taking advantage of if you were to change your banking into Wealthsimple. Now, I hate to throw this plug in there, but if you would like to bank with Wealthsimple and see what they got, I'll throw my referral code in there. If you do open an account, you will get $25 as well as I will. So I do benefit from you opening an account, but I honestly can say I've switched everything over from RBC. The banking with Wealthsimple has been flawless in my opinion, and the benefits definitely outweigh any cons you could throw at them. So yeah, that's a lot of rambling, but that is what I'm going to tell you for today. And just to show you kind of quickly here, I will scroll over here. This is just a video of today's dividends. I can just show you, scroll through. You can see all the different amounts from the different stocks that I hold. And that comes in every month. So that'll slowly grow as I diversify the portfolio more. But yeah, hopefully you guys understood all of this. If you don't, I can definitely break it down with a lot simpler terms. But thanks for watching.